Okay, sir, we are live now.
Welcome you all. This session, as you must have received our emails. So this session has been arranged in order to give, a description or brief about the ESG guideline. The
रिकॉर्डिंग
IFRS.
करिएगा, रिकॉर्डिंग कर लीजिएगा, रिकॉर्डिंग ऑन कर लीजिएगा. We may need later on.
Yes, sir. The recording is on.
Okay, thank you.
So, Bismillahirrahmanirrahim. I welcome you all. So we begin the webinar with recitation of Quran. A'udhu billahi minash shaitanir rajim. Bismillahirrahmanirrahim. Qul huwallahu ahad, Allahus samad, lam yalid wa lam yulad wa lam yakul lahu kufuwan ahad.
Sadaqallah.
Jazakallah.
So now we begin this webinar. As you all know that the webinar has been scheduled in order to give you a brief about the IFRS 9 ECL guidelines that were issued by Accounting Standard Board of ICAP on request of Securities and Exchange Commission of Pakistan to help industry in the application of IFRS 9 ECL model on circular date balances. So I would like to invite Mr. Maqbool, Mr. Mohammed Maqbool, Chairman Accounting Standard Board, to give his remarks about it.
Thank you, Imran Sahab, and thank you, participants, for being available today to attend this very important discussion through this webinar. ECL model is a forward-looking model and requires the organization to work out the expected credit losses and account for in their financial statement. But the one very tricky area here in Pakistan, we have been having this circular debt area. And there was the need which SCCP realized that there should be some guidelines so that people should have some parameter to calculate this ECL model. You know, this IFRS 39 earlier, now IFRS 9, there have been exemptions and sometime granted by State Bank of Pakistan for financial sector, and then also SCCP for many entities, and particularly power project and power producer. This has been around since long. Now, ultimately, the SCCP have issued the circular a notification saying that from for the accounts ending on and after 31st December, this IFRS applicable ECL model is working is required. So this is one thing which we have been extending various times, but ultimately this is and in the same circular they have talked about the guideline which they required ICAP to issue, and ICAP has issued that and has shared with the Securities Exchange Commission of Pakistan. And another thing which has also emerged is the State-Owned Enterprises Act. And under that act also, now the entities are required to follow IFRS, full IFRS. When we say full IFRS, mean these exemptions will not work there. They have to apply irrespective of modification and the exemption. They have to apply the full IFRS issued by International Accounting Standard Board. So this is where we are standing, and we have recently also issued the compliance statement and dividing the SOE in two parts. One, those SOE which will be preparing their accounts for the period ended before 30th January 2026. This is the deadline to follow the IFRS in preparing the financial statement. So one is those the company, those period. which is before 31st January 2026. And then the period which will be ending after 31st January 2026. And for the first one, there is still option. People can follow the full IFRS or the ISO adopted by the SCCP. But for the accounts ending after 31st January 2026, which virtually mean accounts ending after 31st December 2025, they have to follow the full IFRS. Okay. Similarly, under the SCCP circular, the account ending on or before 31st December 2025, they are exempt. After that, they have to follow the IFRS 9. And for that, this guidance would be very useful. So we thought we should have some session, answer people's questions and their issues which they feel are around in following this guideline and build their capacity to work out the ECL using this guideline or the more appropriately, the requirement of IFRS 9. So for this purpose, we decided to hold a series of webinars because we think its time has come where people have to go for and applying the requirement of ECL. So that's why this session is arranged. And I was really personally expecting that many our members and user preparer of financial statement and their staff would be interested in attending this. But even it's a thin attendance, but we would like to still go on and discuss this guideline and take the questions and the issues which could be involved and how to go around. So this is the purpose of this webinar. And I thank the Saab Ghazi Saab for his availability because he has been heading the working group on this topic, and also I also thank the staff member, Mr. Imran, Sameer, and Babar for arranging this very important webinar. Thank you, and just relax and enjoy this webinar and with full focus. Thank you.
So now I would like to ask Mr. Sameer to give a presentation on the requirements contained in the IFRS 9 ECL model in IFRS 9 through a presentation which will cover the contents of our guidelines. So over to Sameer.
Assalamu alaikum. Is my screen visible?
Yes, visible.
Yes, yes.
Okay. Hello everyone. I'm Sameer Akbar from the Director of Technical Services, serving as a Manager Technical Services ICAP Lahore office. So I will be giving this presentation on the guidelines on the application of IFRS 9 ECL model on circular debt earlier issued by ICAP. So basically, SCCP in February 2019, adopted the IFRS 9, and it subsequently in November 2024 issued an SRO, according to which the dues from government related to circular debt will be ECL 9 model on the circular debt will be applicable from January 1st, 2026. So what is a circular debt? As everyone in the session knows about it, but the ECC of the cabinet clearly defined the circular debt in 2014 as the amount of cash shortfall within the central power purchasing agency, which cannot pay to supply companies. Okay, so basically, when one of the participants in the power and gas sector defaults on its payment, withhold its payment, it triggers a ripple effect across the supply chain, causing liquidity and operation challenges. So that's why the trade receivables due as a circular debt are delayed, and we require ECL 9 implication on those circular debt. So the related entities in this case would be all the entities in the power and gas sector distributing the energy supply chain. That includes oil and gas exploration, production companies, gas marketing, distribution and supply companies, in IPPs, power, GenCos, NTDCL, DISCOs, etc. So that was an overview of circular debt, as I assume everyone would be familiar with that. If we come to ECL 9 under IFRS 9, so every financial asset under IFRS 9 is subject to ECL model. ECL expected credit loss is basically what IFRS 9 defines the ECL as the weighted average of credit losses with respective risk of a default occurring as weighted. So basically, there are three things: a credit losses with the respective risk of default, and the third is basically the weightage that we assign to those credit losses. And what is credit loss? A credit loss is the difference between the actual cash flow that is entity expect to receive discounted at the original effective rate and its difference between the cash flows that are contextually due. So basically, that difference will be the credit loss, and we have to assume the risk of default on these credit losses and occurring as a weightage. We have to assign some probabilities to those credit losses. Then we come to our expected credit loss. The name itself tells us about the expected credit loss under IAS 9. So it is not only intakes the risk of default, it also assumes the amount and timing of payments and other factors, as I will be discussing in the upcoming slides. Okay. So what is the factors that we should consider while calculating our ECL, particularly in relation to our circular debt? IFRS 9 basically requires that an ECL model should reflect a range of unbiased and probability outcomes, time value of money, and reasonable supportable information based on the consideration of historical events, current conditions, and forecast of future economic conditions. So basically, as Makbul Saab said, ECL is a forward-looking model where you have to incorporate the different factors based on your current and supportable information, reasonable and supportable information based on the future events. So what will be the factors of ECL on circular debt, which include credit risk associated with the counterparty, the time value of money in use of appropriate discount rate, which we will be discussing in the coming slide, the expected recoveries based on the government settlement plans, expected timing of cash flows based on the reasonable and supportable evidence, and probabilities assigned to various outcomes and timelines. So we have illustrations, as you very well know. We have included illustrations in our guidelines that we will be presenting, but these are the factors which we have to include in our calculations. So, as you know, the expected timing and expected recovery will be based on our expectations. So there is a measurement uncertainty that arises when monetary items in financial statement cannot be observed directly and must be estimated. But all these estimations, as very well know, should be based on our reasonable and supportable information that the entity currently has.
Samir, there is some
What is the basically approaches for the trade
disruption from your end. I mean, we cannot hear
Yes,
you clearly. So kindly use mic if possible. I mean, there is some disruption. Or close your laptop. Make close to yourself so that the
Okay.
voice goes through clearly. And if you want to explain something, you can use Urdu as well. I mean,
Okay. So, is my audible? Am I audible? My voice is clear.
yeah,
Yeah,
now clear.
I can hear clearly, and Amir also mentioned, one of the attendees, that he can hear clearly.
There
Yeah,
may be
you are clear. Your voice is clear.
Okay. Okay. So basically, there are two approaches in the IFRS 9 for the measurement of ECL. One is simplified approach, and the other one is general approach. IFRS 9 clearly states basically the financial component of financial assets, just like trade receivables that don't have a significant financing component. The simplified approach must be followed. And when there are some financing component included in the contextual term, then you may have to apply the general or simplified approach, which in the general approach, as you all know, that has levels. You have to estimate the ECL over 12 months and then lifetime ECL. In context of circular debts, the receivable are basically the short-term nature as per the contextual terms, but obviously they are delayed due to various reasons. So the objective of the ECL is not to provide the financing and as per the agreed terms under the contextual terms that are obviously a few months. So According to this guideline, the circular debt would be a short-term receivable, and we will be applying a simplified approach of ECL 9 on the circular debt. But however, if an entity has determined that its contractual arrangement contains a significant financing component, then it obviously have to choose the general approach for the calculation of ECL as provided in IFRS 9, and it shall have to apply the requirements of IFRS 9 accordingly. So if we come to the general approach or how ECL is calculated, so basically under IFRS 9 doesn't give you a proper methodology, but it provides the factors you have to include in your calculation that are generally calculated as a sum of your all the probability of default multiplied by the loss given default and the exposure F default, taking into account the time value of money. So basically what is happening here, you have to assign some probability of default to your counterparty to your expected cash flows. You have to estimate what would be your exposure to that default, and if there is any security or any collateral, then you have to estimate your loss if that defaults happen. And by taking into all these consideration and the time value of money, you calculate your expected cash flows, your ECL, which is basically the difference between the contractual cash flows and the estimated cash flows. So considering this erratic nature of circular debts, relying on probability of default and LGD estimate from the historic data may not be practical. So taking into account all these factors, जो हमने approach develop किया वो basically would be divided into two components. First of all, we would be computing an estimate of expected credit losses based on past recovery trends, if any. And then we have to develop an expected credit loss considering expected future recoveries against circular debt receivables in present value terms. तो इन सब के लिए कंपनीज के पास गवर्नमेंट सेटलमेंट प्लान्स होंगे, उसके अलावा जो टर्म्स होंगी उसके रिलेटेड, उसके बाद हम उसको फ्यूचर रिकवरीज के अगेंस्ट हम उसको कुछ प्रोबेबिलिटीज असाइन करेंगे जो फैक्टर्स हमने ऊपर पढ़े थे. तो उससे रिलेटेड हमने इलस्ट्रेशन जो बनाई है वो हम प्रेजेंटिंग दोज एट द एंड ऑफ द स्लाइड्स. So after calculating ECL based on the historical patterns and based on the future information, we will take the higher of these two. Okay, so higher of these two would be presenting our expected credit loss unless the entity has a clear evidence and demonstrative and sufficient evidence to believe that future recovery plans would be favorable than historical experience. So obviously, if entity has evidence and it can sufficiently demonstrate that evidence, तो हम फिर obviously जो हमने एक estimate develop किया था फ्यूचर बेसिस पे वो लेंगे, इवन वो कम ही क्यों ना हो हिस्टोरिकल पैटर्न से. तो इससे रिलेटेड हमारी जो गाइडलाइंस थी उसमें डिफरेंट क्वेश्चंस थे. ये जो अभी मैंने आपको सारा एक्सप्लेन किया ये भी उसी क्वेश्चंस में कवर थे, बट एडिशनल कंसिडरेशंस जो हम ले रहे हैं, जो क्वेश्चंस आते हैं गाइडलाइंस के अंदर और जो सारे फैक्टर्स आते हैं वो हम इलस्ट्रेशन से पहले हम वन बाय वन उन क्वेश्चंस को डिस्कस करेंगे. और वो क्वेश्चन में जो एक क्वेश्चन रेफरेंस है ये वो गाइडलाइंस वाले क्वेश्चन है. सो द फर्स्ट ऑफ ऑल इज द क्वेश्चन नंबर 3 in the guideline. So the question is whether for ECL calculation an entity should pool all circular debts related to receivable or consider them separately. So as you all well know, the standard requires.
We will answer the questions at the end of the presentation. Whatever the questions that come from participants, we are seeing them, and once the presentation is over, we will be, addressing those questions, answering.
So first of all, जो circular debt है वो different parties से होता है, तो how we should pool them and how should we pool them for the purpose of calculating ECL on a pool of circular debt. The standard requires an entity to assess whether financial assets share similar risk characteristics. So based on those similar risk characteristics, we have to pool the circular debt in different pools and then have to apply ECL on the different pools of ECL. So what is those risk characteristics? They are basically the counterparty profile, they are the settlement plans, they are the aging of the circular debt, historical recovery pattern, or exposure to common risk drivers. If these risk similar risk characteristic exists. So we have to pool those circular debt separately, and we have to apply ECL on that pooled circular debt. Coming to the next question. So that's a pretty common question, whether an entity is required to calculate ECL for the amount that are granted by GOP. So the answer is yes. Paragraph, as you can see on your screen, the paragraph B 5.541 of IFRS 9 requires that an estimate of ECL shall always reflect the possibility of credit loss and the possibility that no credit loss occur. यू कैन बेसिकली इसका मतलब ये होगा कि आपने प्रोबेबिलिटी लेनी है क्रेडिट लॉस होने की भी और नहीं होने की भी, इवन इफ द मोस्ट लाइकली आउटकम इज नो क्रेडिट लॉस. And the paragraph 5.517A requires the estimate of credit losses that reflect an unbiased and probability weighted outcome that is determined by evaluating a range of possible outcome. So टाइम वैल्यू ऑफ मनी वुड बी अ फैक्टर जिसकी बेसिस पे हम ECL कैलकुलेट कर रहे होंगे, वो हम आने वाली इलस्ट्रेशंस में कवर करेंगे. Then coming to question number 6 of the guideline, how to consider default risk of a counterparty when amount due is not granted by the government of Pakistan. So if the amount recoverable from the counterparties that are not backed by government of Pakistan sovereign guarantees, we have to apply the same framework of ECL that is provided in our guidelines. However, when we estimate our cash flows, we will apply an additional factor of expected credit loss on those receivable because they are not backed by the guarantee. So there is an expectation that the whole amount will not be recoverable. And even if there is some guarantee, so we will have to evaluate the loss given default. अगर loss होता है तो कितना default होगा, and we will be adjusting our cash flows accordingly in the given framework of ECL calculation. And then what should be the period of ECL calculation? As we know, the simplified approach consider the lifetime ECL approach. So the estimated credit loss on the circular debt would be the entire period they are exposed to credit risk. For example, if an entity requests amount within 30 days, but expect customer to pay within 90 days. So we have to incorporate the expected timing of cash flow, not the actual or contractual one. That's what the purpose of ECL basically. And then whether review of ECL is required at each reporting date. So yes, IFRS 9 requires the ECL impairment estimate should be reevaluated at each reporting date based on the available data at that reporting date, which would be obviously changing over the year and by considering available historical and forward-looking information. And if we come to question 8, which aspects should be considered by entity in terms of relevant available information? So IFRS 9 basically requires to reflect available information that is relevant to assessing the collectibility of cash flows. So in this case, as the entities are in communications with the government and the whole settlement plan, so they would have first-hand information, and that information should reflect the historical loss information adjusted for current conditions and forecast forward-looking information about the future economic conditions. But that information should be reasonable and supportable by the data. And in case of limited forward-looking information is available to entity, then obviously it is required to revert to historical patterns if it cannot develop a reasonable forecast of the collectibility of the cash flows. Okay, so question number 11, is it possible for different entities to have different views for the future when establishing their allowances? So the short answer is yes. Why? Because the entities may have different views for the future, because this is a core judgment, and every entity, based on the facts and circumstances it can develop different forecasts, assign different probabilities to a same amount of cash flow from a same entity. But as I said, the information should be reasonable and supportable in all cases. Judgment must be used in considering conflicting forecast about the future. While internal information may be used, but entity must also consider relevant external and market-based evidence and should be able to justify those forward-looking views and resulting ECL estimate. As you know, we have to disclose that information in our financial statements as well. So whatever the information is using, whatever the estimate and entity is driving, it should be reasonable and supportable in all cases. Question number 9, how timing for receipts or settlement plan of circular debt balances could impact in ECL calculation, and why time value of money is relevant for calculating ECL for circular debt. So ECL model basically require the calculation over the period that entity is exposed to risk. For ECL on circular debt, the expected there are two things basically: the expected amount and when you are expecting those amount. So when you take these two factors and apply probabilities to these amounts at their expected timing, you will have an amount that you expect to receive, and that amount is basically will be compared with your contextual cash flows, and the difference would be ECL. So regarding timing of payments, a credit loss arises even if the entity expect to be paid in full, but later than when contextually due. So that will be a time value of money factor in that. Even if there is a they are expected before 12 months, and there's a material time value of money factor, so you have to include that also in your ECL calculation. So that time value of money would be relevant in such cases where expected settlement of circular is more than 12 months and the exposure expected shortfall. And even if, as I said, the cash flow expected within 12 months, but the time value of money factor is material, you have to consider that in your calculation as well. So the core question is, which discount rate would be used for calculating the time value of money or circular debt receivables? IFRS 9 basically said the original effective interest rate of the financial asset should be used, and if that is not available, a close approximation of that interest rate should be used in order to calculate the ECL. In our case, as circular debt balance are short-term in nature, we do not discount them that do not contain a financing component. So the approximation of that effective interest rate would be, in case of LPS, the rate of LPS would justify that delayed payment. So we would use LPS in the calculation of ECL. And if there is no LPS, then the effective imputed borrowing rate utilized in connection with such debt balances would be our discount rate to be used in the calculation of ECL. So if we come to question number 12, so IFRS 9 basically requires ECL application without undue cost or effort. An entity may need guidance on this aspect. So what is meant by undue cost? Undue cost or effort, basically reasonable, as I said, the reasonable supportable information is should be used, but that information is such information which is reasonably available at the reporting date without undue cost or effort, including information about past events, current condition, and forecast of future condition. You should have readily available those information. You don't have to search or implement resources to collect those information. The information that resides with the entities will be used for the calculation of ECL. And then whether to incorporate event run forecast, which occurs and becomes after the after the reporting date in the ECL calculation. So the answer is that there's a concept of adjusting event. So IFRS 9 requires expected credit loss to reflect information about condition that existed at the reporting date. The information that becomes available after the reporting date is not incorporated in ECL unless that is an adjustive event and it provides us evidence of the condition that already existed at the date. So if the information is related to adjusting event, we have to include this in the calculation of ECL, and if that is not an adjusting event, we don't have to include that in our calculation of ECL. And materiality consideration should be also kept in mind while considering that information in the calculation of ECL. So if we come to question number 14, how IFRS 9 ECL model application would differ from currently applied IAS 39 impairment requirement. So basically, IAS 39 impairment requirement was a type of incurred loss model when the other party has actually defaulted. Then you have to recognize the credit losses. But the ECL, as you well know, the ECL is basically based on the forward-looking approach. So you don't have to wait for the actual credit loss to be incurred. to recognize ECL. So that's why ECL is a more forward-looking approach, and entities are not required to consider the information that includes forecast of future economic events, including multiple scenarios and time value of money to calculate the ECL on the circular debts. And the next question is question number 15 of the guideline. How would an entity to transit to IFRS 9 when implying ECL model on circular debt balance for the first time? So entity must restate prior periods if and only if it is possible without the use of hindsight. So basically the point is, if that information was available to you at that reporting date, then you have to use that information for the calculation of ECL. If that information is became available after that reporting date on which you are calculating ECL, you don't have to consider that information for the calculation of ECL on the prior dates. And you have to adjust your retained earnings of the annual reporting period that includes the date of initial recognition to take the effect of ECL on the prior dates in your financial statement. Okay. So these were the question, additional consideration that comes to the mind when we'll be calculating ECL. So that was the question was well answered in detail in our guidelines, and we have a snapshot here which I have explained. So the scenarios where entities can have circular debts and how ECL on those circular debt would be calculated. You can see the picture here. You can see a flowchart where there are two type of entities, basically a government owned or control entities and the other corporate entities. And from both of these entities, the ECL could be secured. The circular debt could be secured or unsecured, and the security can be in the form of government, a sovereign guarantee, or some other collateral you might have. So on all these, whether they are secured by government, other collateral, or sovereign guarantee, you have to estimate the ECL on these circular debts. And how that ECL is calculated, basically, we have came up with a approach of ECL. Basically, as I already explained, the ECL for the ECL on circular debts, we will be calculating an ECL based on the forward or future looking factors, and an ECL on the historical pattern, and we'll be taking a higher of these two. If we can clearly demonstrate that the future looking factor is more reliable in the scenario, we have reasonable and supportable information, then obviously if it is lesser, then we will be using that in our ECL calculation. So we have developed an approach that will have these steps. So first of all, to calculate ECL on the circular debt based on the future factors, that would have the following steps. First of all, we have to consider the contextual terms, and if there is any financing component, security, late payment surcharge, we have to see those contextual terms and take into account in our calculations. So all the contextual cash flows of the circular debt of the trade receivable is considered in our calculations, and then we have to build scenarios as the definition of ECL itself says that we have to assign probabilities weighted to different scenarios. So we have to build scenarios reflecting the different possibilities of the timing and amount. So basically, these are the two things that we have to make an expectation of when the amount of circular debt is coming, and what amount will be coming as an inflow to the entity. And then we have to assign the probabilities to each of these scenarios based on our best judgment, which should be supported by the spot information available to the entity. And then we have to compute the expected value of the cash flows. How it will be calculated, I will be presenting examples of each scenarios in the coming slide. And then we have to compare this with the contextual cash flows that are actually due. So the difference would be our ECL. Okay, so all these steps making into an illustration would be something like this. Okay, so first of all, we have illustration A. The circular debts that are secured by sovereign guarantees and carry an LPS. So let's assume we have a circular debt that has an amount of 200 million. The effective interest rate of the LPS is 13.75, and they have a sovereign guarantee. Any default would trigger an LPS and delay in short at the rate of 13.75. So first of all, what we have to do, we have to make an estimation of how much trade receivable is coming and at what time it is coming. So for the purpose of calculation, as you can see, we have different scenarios. Trade receivable, which is received in 1 year, and LPS is received in the second year, and 50% of trade receivable is received in the after the year 1, and 50% after the year 2, and the whole trade receivable and the LPS is recoverable and expected to be received in year 2. So you have to make your own scenarios based on the information you have. For example, in the guidelines, first of all, we have taken a scenario where trade receivables and the LPS is expected to receive with a delay of 1 year. This is the amount. And then trade receivable is received within after first year, and LPS after second year, and then 50% of both is receivable in first year and second year, and at the end we have an expectation that all the trade receivable and LPS will be received in second year. So these are the contractual amounts. They are covered by sovereign guarantee. So we have assumed that whole amount will be receivable and at different timings. So okay, sorry. So what we have done next, we have assigned the probabilities to each scenarios. You can see the sum of that would be obviously 100. We have to assign the probabilities based on our judgment. That's what we have done. We have assigned different probabilities to different scenarios, and then we have taken the present value of those amounts in current values from discounted at 13.75. As we have explained, the discount rate would be LPS, and in case of absence of LPS would be our imputed borrowing rate. When we discount those cash flows at a present value terms, and then we apply the probabilities on those values, that comes with probability weighted average value of expected cash flows. So when we sum all those cash flows, that comes to around 198,612. So this 198,612 is our expectation, taking into account time value of money, taking into account everything that we are expecting from the counterparty. So the difference between two would be obviously our ECL. This approach is based on the future-looking factors, and you also have to develop an estimate on the historical economic losses sustained by the company based on your prior experience. And if, for example, that comes around 0.5% of the amount, and that is 1,000 million. So that is which would not be recoverable, and the higher of two would be obviously 13.88 million, which would be considered an ECL against such receivable, unless, as I said, the entity has a sufficient and demonstrable evidence that the future recovery pattern would be favorable than historical pattern, and then if that amount is lesser, you have to consider that as ECL. So if we don't have LPS, then obviously in the expected timings and expected cash flows, we will not include LPS, but the borrowing rate would be effective imputed borrowing rate of the entity. We will develop all those scenarios. We will develop our expectations when this amount will be recovered, and then we will apply the present value method. At that 15%, we will discount those values, and the present value we will multiply that with the probability of expected cash flows, and the resultant we have to sum all the scenarios, and the final amount which is what we are expecting to receive. So in these scenarios, as you can see, in each scenarios, that 200 million is recovered in full because that is secured by sovereign guarantee. But the thing that is affecting the calculation is basically the 15% the entity is receiving after year 1, after year 2, and the probabilities of all these scenarios. So that comes to around 165 and 974, and the difference would be expected credit loss. After each reporting date, some amounts will be received and some will not be received. And after each reporting date, we will re-estimate that, and the difference would obviously reduce over time if we have an inflows, and that will adjust all these values accordingly in the future years. So if we come to the illustration which is secured by counterparty and have LPS, the calculation would be same. There is no change in that. But as we have in some question, we have noted that we will include an additional factor of loss given default. If that security fully satisfies your contextual cash flows, then we will not have to worry. We will have to include full amount of all the cash flows. We will assign the probabilities. We will calculate present value of the expected cash flows, and we will calculate our total amount, and the difference would be ECL. But if that is, if you can see, we have developed an estimation of 90% of total receivables are expected to be received in year 2. So there can be different scenarios on the basis of information you have. This is just a demonstration, a guidance. There can be something like 80% of the full amount is expected to be recovered in year 1, 50% of the amount, and you can assign the probabilities of each amount. But the probabilities obviously are going to be, the sum of the probabilities is going to be 100%. And when we will calculate the present values of different cash flows, it will give us the amount of our expected cash flows. So when we don't have a sovereign guarantees and our security, the collateral or security of the counterparty doesn't cover our financial asset, our circular debt, then we have to estimate the credit risk factor that is defined here. The result of above ECL calculation will need to be compared with estimated determined based on historically suffered by the company. Further, entity should also incorporate credit risk factor based on the assessed default risk of the entity while determining such estimate. So that will be the additional factor in case of the ECL that are not covered by the sovereign guarantee, and that calculation would have to be incorporated in our calculation. So the example, the pattern, the flow of the ECL calculation would remain same in all of the calculations, whether that are recoverable from the party, whether that are recoverable from the government-owned entities. But the difference would be where the counterparty does not provide the sovereign guarantee. So there we will have to apply an additional factor of loss given default. You can apply directly into the cash flows, or you can apply separately, and then the calculation of ECL, the expected value of cash flows, would give you an amount that you have to take a difference with the contextual cash flows, and the difference would be your expected credit loss. You have to assess that in each of the coming years, and that's how you're going to be calculating your ECL on the circular debts. Thank you. That's it from my side.
Thank you, Shamir, for your detailed presentation. Now, Imran sir, what the next step is? Are you going to take question answer, or is there any other point you want to raise from your side? Okay. So there could be two types of questions. One people can raise, the other can be in the chat box. So we should go for the question which are already in the chat box. Once they are over, then you can open the floor for the members. They can raise the question. Okay.
Okay. The first question is whether, existence of late payment surcharge in the contractual arrangement indicate that there is a significant financing component or not. The agreed period for payment, for the transactions in the, energy sector supply chain is generally less than, a year. So what we understand from that, as per the agreed payment terms, so there does not exist a significant financing component. However, if an entity determines, it is a matter of judgment, entity need to consider the factors given in IFRS 15 for determination whether a significant financing component exists in their case or not. If it exists, then obviously they will have to, adjust the transaction price accordingly as provided for in the IFRS 15. And further, as regards IFRS 9 ECL model, the standard IFRS 9, gives you a choice if you have a significant financing component in the arrangement, that you may apply either a simplified approach or a general approach. So what we have done is we have based these guidelines on simplified approach basis, meaning thereby that you will have to calculate the ECL considering the life lifetime, expected losses, over the life of the, receipt of the receivables. When you apply the general approach, obviously you will have to go for the staging. You will have three stages: stage one, stage two, stage three, and accordingly, I mean, you will have to monitor the credit risk, and then you will have to, go for full, provisioning, based on the stages that you've determined. But when you go for the simplified approach, which we think is practical in case of secular debts, because we know, I mean, the entities can expect and can, compute the probable recoveries, based on the expectations and based on the future, future expectations, which the entities, may determine based on their correspondence with the government, and the correspondence of the with the other entities, and they can develop the forecast, various forecasts for depicting the estimated, recoveries against their trade receivables, and then they can discount them if, let's say, the expected recoveries are, over a period more than a year. So what we have done is we have applied a practical approach, which we think is practical for calculation of ECL in case of circulated balances. That is applying, estimating the lifetime expected credit losses, using the expected recoveries, based on the future forecast and the historical, experience. The other question is, I mean, when the circular rate is a common issue for all entities, and it will be resolved for all at the same point of time, then if different companies have different timing, results may vary significantly. I mean, this requires, every company to look at their receivables and to look at their circumstances, and to look at the circumstances of every company, may not be the same. The entities will have to use their judgment, will have to use their knowledge, their past trends, their future expectations, and based on that, they will have to develop different scenarios for recoveries of their trade debt balances. They will have to assign probabilities, and they will have to use, appropriate discount rate. And based on that, they will have to, develop a weighted average of the possible recoveries, and then they will have to compare with the past recovery trends and past provisioning, past trends of recoveries, and determine appropriate amount of ECL. So this may not be the same, and the provisioning may not be the same. Actually, it is an estimate. So estimate may vary from one entity to another, and it requires, management to exercise their judgment based on their uh, facts and circumstances. So this may not be the same for each and every company.
There are no further question in the chat box.
I think there is one in Q&A, Imran.
So
Yes,
yes,
sir.
Mr. Farid. Why we
Please
need to
see the
approximate the discount rate if there is no financing component, as IFRS 9 requires instrument to be discounted using original effective interest rate. ऐसे ही है बेसिकली जो आपका फाइनेंशियल एसेट है वो आपके कॉन्टेक्चुअल टर्म्स पे चलेगा और ईसीएल ऑन डेट फाइनेंशियल एसेट आपकी एस्टिमेट्स पे चलेगा. सो द पैराग्राफ ऑफ IFRS 9B 5.5.44 दैट इज बेसिकली क्वेश्चन 10 ऑफ आवर गाइडलाइन. उसमें IFRS 9 clearly says the entity should use the original effective interest rate or an approximation thereof. जैसे इमरान साहब ने कहा है कि ये फाइनेंशियल एसेट्स जो हैं वो होते ही विद इन 1 ईयर है, तो इफेक्टिव रीजनल इफेक्टिव इंटरेस्ट रेट तो जीरो होगा. तो अगर हम उससे डिस्काउंट रेट लेते हैं, बेशक वो 3 या 5 साल बाद भी आपकी एक्सपेक्टेशन है, तो आपके पास तो कोई डिस्काउंटिंग ही नहीं होगी और आपका जो इफेक्ट है ECL का जीरो निकलेगा. So the requirement of IFRS 9 would be to use an interest rate that is an approximation thereof, जो हमने एक्सप्लेन किया है कि LPS के केस में LPS वो डिपिक्ट कर रहा है, और अगर LPS नहीं है तो आपका इफेक्टिव इम्प्यूटेड रेट है तो वो उसको डिपिक्ट करेगा. तो हम उस इंटरेस्ट रेट को लेके हमारी जो एक्सपेक्टेड फ्यूचर रिकवरीज हैं उनको डिस्काउंट करेंगे, क्योंकि ईसीआर में आपने दोनों चीजों को एस्टिमेट करना है, टाइमिंग को भी और आपकी एक्सपेक्टेड कैश फ्लोज को भी। फाइनेंशियल एसेट के केस में ऑब्वियसली देयर वुड बी नो
अच्छा, इसमें एक चीज
फाइनेंसिंग कंपोनेंट।
अच्छा, इसमें एक चीज मैं यहाँ ऐड कर दूं कि यहाँ पर आपके सर्कुलर डेट के बैलेंसेस बहुत बड़े हैं, और ऐसा भी हो सकता है कि विद इन 1 ईयर, लेट्स से ओवर अ पीरियड ऑफ 6 मंथ्स या 6 मंथ से ऊपर का पीरियड पे आपके रिकवरी पैटर्न्स हैं, लेट्स से 7 मंथ्स 8 मंथ्स, और आप देखते हैं आपको उसमें लगता है कि आपके जो इम्पैक्ट ऑफ डिस्काउंटिंग है वो मटीरियल है, तो एंटिटी उसको कंसीडर कर सकती है और उसको जो है उसको ईसीएल की कैलकुलेशन में उसको कंसीडर कर सकती है, क्योंकि यहाँ पे बैलेंसेस आपके बहुत बड़े होंगे और एट टाइम्स आपको ऑडिटर्स की तरफ से भी चैलेंज आ सकता है इस पे। तो स्टैंडर्ड जो है आपको, यानी आपकी एस्टिमेट है और उसको आपको देखते हुए कि आपके बैलेंसेस बड़े हैं, और अगर डिस्काउंटिंग का इम्पैक्ट बहुत बड़ा है तो फिर आपको ऑब्वियसली यू शुड कंसीडर दैट।
Okay, let's go to now personal question. If anyone want to raise any question, most welcome. Please just inform us about the name, your entity, and then you raise your question, please. Any question?
Imran, can
Okay, Imran
they,
sir.
I mean,
Yeah, please
वो
go ahead. Please.
लाइव क्वेश्चंस आस्क कर सकते हैं आपने वो, आई थिंक।
ये हो सकता है इमरान साहब लाइव क्वेश्चन?
जी सर, आज पूछ सकते हैं, क्योंकि
हाँ
उसमें बीच
हाँ
में आमिर भी बोल रहे थे ना।
हाँ
नहीं,
हाँ,
आमिर
ठीक है
तो
ठीक।
अपने क्वेश्चंस दे रहे थे, आई डोंट नो।
नहीं, ही आल्सो स्पोक इन बिटवीन।
जी सर, लाइव क्वेश्चन दे सकते हैं, ऑडियो पे हम ले सकते हैं सर। तो अभी दो जो पार्टिसिपेंट्स थे हमारे, असद और एक जो है रेहान कुरैशी, उन्होंने हैंड रेज किया था, बट आई डोंट नो इफ दे वांट टू स्पीक। इफ दे रेज हैंड अगेन, देन आई अलाउ देम टू स्पीक।
So those of you who want to ask a question can raise their hand so that Babar can allow.
Okay, looks like there's no question. So, Shwab Saab, would you like to say anything relating to this subject?
Thank you, Makbul Saab. I think the opening remarks that you gave and the need that is there, that as a country and as all the organizations, we follow IFRSs. And as you mentioned, that SOEs have, I mean, requirement most likely starting from next year. They will have to go for full IFRSs. So I think it's the need of the hour that all the entities, all the industries should consider that wherever the relaxations are there, they should. I mean, it is my understanding that SECB may not be renewing those relaxations, and companies should voluntarily even go for applying all the IFRSs. I can understand that our situation is a bit peculiar in this country because of the circular debt. But IFRSs allow the estimates to be made, judgments to be made, and as long as, I mean, they are reasonable and supportable, I think a good outcome can come out of it. Yes, there could be variations in the results of the similar type of companies, but that's, I mean, probably common for any other estimate as well, I guess. So I think because of that, this should not be delayed or deferred further. And this is my view that we should be doing our best. I would recommend that everybody to do their best and have their teams work on it so that for their next closing, they're able to apply this. And I think the part that they don't have to go full retrospective approach and they only have to adjust the opening retained earnings should also be helpful, that they all only have to do it on two cutoffs and not going behind many years. So those are my thoughts.
Thank you. Thank you. There's Talanasi, some point is there. Can anyone read that point which is raised by Tala?
Yes, it is based on it. It may be based on the expected period of receiving the debt I mean, both the factors need to be considered. You have a credit period of, let's say, 90 days, but you expect that the amount, the recovery shall be made
Expected
after 1 year.
period.
Yeah. So that
Expected period.
I mean, IFRS 15 also requires to consider that those expected period as well. But in that case, I mean, you'll have to adjust the transaction price as required by IFRS 15, and you will have a choice either to apply, general approach for calculation of ECL or simplified approach. And our guidelines are based on simplified approach because that allows you to calculate, lifetime expected credit losses rather than going into the staging, exercise, that would involve, a lot of time.
Okay.
As I said, I mean, you need to exercise judgment. You cannot say that it includes a significant financing component. You will have to use the guidance available in IFRS 15. It's not that simple. If you have not received, LPI since a year, if you have not received LPI since a year, we can include that there's a significant financing component. You'll have to see the requirements of IFRS 15, and you'll have to use your judgment, other factors as well, and then you can determine whether there is a significant financing component or not.
Okay, Imran Sahab, I would suggest that if you can put in the chat box the contact person detail. Anyone want to have some question answered quicker, so that they can they apply the guideline. So we should be able to support them by answering their
Yeah, they
query
can.
quicker.
I mean, anyone. I mean, yeah.
You can give Sameer or Babar,
Helpline is
whoever's name you
available.
think more appropriate, and the
Yeah.
email address and the person name here in
Yeah.
the
The
chat
Babar email
box.
address is available to the industry because I mean all emails were sent by Babar, and so if
Yeah,
they
put
have
the
any
Babar's
specific
email
question, they
for
can
ready reference.
contact us through our
Babar, put your
helpline.
email there. Put your email there for ready reference.
Yes,
quick
sir. I'm
noting.
putting my email address there.
Yeah. Try to respond within 24 hours when you receive any query. Myself, Imran, Shuaib Sahab would be there to support you in meeting this target. So try to fix a time like maximum 24-hour to turnaround time on any question you get from any participant or anyone from the industry. I believe this is all. If there's no question,
I mean,
further
you need
question.
to approximate the. There is a question why we need to approximate the discount rate if there is no financing component, as IFRS 9 requires
Yeah.
adjustment to discount rate using original. Because in that
Yeah.
case, I mean, you are not receiving the amount of receivables within a year, and you are incurring. The logic is that you are incurring time. The time value of money is involved. You're not the rupee that you receive now will not be equivalent to the rupee that you receive after 1 year. So obviously.
Imran got disconnected, I think. Samir had responded to this, I think, earlier.
Yes.
Yeah.
तो क्योंकि आप उसको
Okay,
लेट रिसीव कर रहे
so
हो, एक साल से ऊपर आपके पास, obviously there is
go
a,
ahead, go ahead.
yeah, so obviously that requires discounting, and for that discounting purposes, you will have to use a discount rate or an interest rate which actually depicts your own internal weighted average borrowing rate, because you're incurring cost on your liabilities, because since you're not receiving receivable within that agreed period of time. आपने रिसीव करना था 30 दिन में, 60 दिन में, 90 दिन में, but you're receiving after 1 year, और obviously 1 year बाद जो पैसा मिल रहा है वो आज वाले के बराबर नहीं हो सकता, तो obviously you need to discount that, and for the discounting that you will have to use an appropriate discount rate, and that discount rate may be the one which you are incurring on your borrowings.
ठीक है.
So let's close it, and thanks the participant for their presence. And we will look forward if there is any question, and we are committed to answer it as soon as possible. The purpose is for the industry in complying with the IFRS, okay, and the requirement of IFRS. So with that, we thank everyone, the team, the website, me, and everyone
Thank you,
who
everyone.
arranged
Thank
this
you.
Thank you.
Thank you.
webinar.
Thank you.
Thank you so much.
Yeah,
Thank
everyone.
you.
Thank you.
Thank you.
Okay, Allah Hafiz.
Allah Hafiz.
It's all
Allah
right.
Hafiz.
Take care. Allah Hafiz.